Deutsche Bank closed out the worst quarter in its history with a turnaround in its stock after it emerged that it was close to agreeing a much smaller fine from the US than had been originally proposed. Mike Ingram from BGC Partners joined us now with some more on this. That was the word at the back end of this week. We've heard nothing over the weekend. One wonders where that fine is going. But first of all, what is the problem with Deutsche Bank?
I think the problems at Deutsche Bank are endemic to the banking system, certainly in Europe. I mean, look at where we are in terms of the interest rate environment. Central banks are falling over each other globally to outdo each other on low rates, zero rates, negative rates, and also through a process of dare I say it, forward guidance, flatten those yield curves, though I'd have to say that they probably don't need much help these days in that respect. That makes it very, very difficult to run a bank profitably. If you think about the bread and butter business of a bank, it's to borrow money short and to lend it long term. If you've got low rates, if you've got flat yield curves, your profit margins collapse. At the same time, regulators have asked them to put aside more capital to fund all their exposures. They've loaded them with extra costs in terms of regulation and so forth. They've insisted that they have more liquid assets, which is again placing them at that short end of the yield curve, generally zero to or even negative yielding assets. What's going to happen in that environment? I can't think of a more toxic combination to collapse the profitability of the bank. So what's left? What are you left with? You're left with just cutting costs where you can. And where is that going to be? It's cutting headcount, cutting back office where you can, cutting branches. So yeah, Deutsche was at an all-time low at one point on Friday, although it had this massive bungee jump. It was down at 9% at one point, ended up. But if you look at the bigger picture, Eurostoxx banks, their post great financial crisis high was in November 2010. It was almost 6 years ago, and it's been trending down ever since. So it's not just about Deutsche, it's not just about it's any single bank, it's the entire sector. And you have to say, even looking over the seas, looking at the Atlantic, you know, the big US banks, which have fared relatively well, you know, they are suffering the same kind of interest rate environment, they're suffering the same kind of regulations. So their profitability is just a shadow of what it used to be as well.
Okay, you're talking about the environment in which they're trading, in which they're doing business, but also there is some criticism about what they've been doing. Even since the financial crisis, they have not been cleaning up their books as they should have done. They've been going into things like, we've been hearing a lot earlier in the year about cocoa bonds, these convertible bonds that Deutsche Bank have had. They've still got into the wrong parts of the business. They're still doing things that, one, they possibly don't really understand deep down, and the second thing is that they're still exposing their clients to too much risk.
Well, I think there are a number of threads here. So for starters, I think that there certainly is the case that some of these banks are so large and so complex that they can't effectively be managed. This was something that was suggested by Janet Yellen, actually, at the last FOMC meeting, and she pushed back from that. She said, well, I think if you have the proper regulation and oversight and so forth, then, you know, there is no particular reason to worry. I would disagree. I would say there are some clear failings in terms of the governance of some of these banks, and that's the reason why they've come a cropper. You mentioned the CoCos. I mean, that's quite interesting. That's funding for the banks themselves, contingent convertibles. That's what CoCo means. Some of these CoCos have looked as though they're going to go pop, to use a breakfast cereal analogy, except no chocolate, so there's not even the upside of chocolate on that one. The issue there, which comes back to maybe sort of like PPI selling scandal, is who has been buying these things? I think a lot of them ended up in the hands of private banks and maybe high net worth individuals. You know, further down the line, you know, where do you think these yields were coming from? Well, they're coming from because it's actually a short option position. You know, why did you think these things were sort of relatively safe when you're getting that kind of yield? But then, again, this is investing in things you shouldn't be investing in. Again, we're coming back to the low interest rate environment, this reach for yield.
So they're being forced to find other ways of making money,
to an extent, yeah, to an extent. And every time a central bank at this stage cuts rates and tries to flatten yield curves and so on and so forth. And now we've come full circle, because Japan is trying to steepen its yield curve to zero at 10. Wow, 10 years. I'm going to make lots of money there. So my concluding thought, because we write books are being written on this right now, is we're in a situation where central banks, by cutting rates, easing monetary policy, say 8 years ago, managed to save the global financial system. The problem is they've kept there, and they're having to keep on finding new tricks, new rabbits out of hats, and governments have just stepped away from it. What that means is we're not seeing capital turning over. We're seeing a lot of problems dormant on banks' balance sheets. You're seeing capital misallocation, labour misallocation. In that environment, productivity collapses, growth collapses, and then all of a sudden it's like, well, governments can't pay the bills, etc. And that has social and political problems. And my goodness, we've been reminded of that in Europe this year. And let's see what happens in the US in the month ahead.
Okay, going back to Deutsche Bank, and in fact, talking about banks generally now as well in Europe, if it wasn't Deutsche Bank, would it be another bank? Would the market forces, the market speculation that John Crime was criticising the other day about the fact that market speculation is hitting Deutsche Bank, if it wasn't Deutsche Bank, would it be an Italian bank? Would it be another German bank? Would there be a problem?
There are plenty of candidates.
Swiss banks?
There are plenty of candidates. Yeah, I mean, if you look at Eurostoxx banks
So
last year,
the whole system has got a problem.
I think the whole business model is being undermined by policies, and the policies themselves are not conducive to growth, and that is also contributing. So we're in a very bad loop, I think, here. And the problem is, how do you break out of that loop? Well, long term, how you break out of that loop, in my opinion, is you actually raise interest rates. You actually raise interest rates and try and flush the system out of some of the toxic stuff which is built up. The problem is, short term, of course, that's extremely painful. And the immediate question for a lot of investors in banks is, well, does that mean that, for instance, non-performing loans go up? Exactly. And do I end up having to bail these things out yet again?
Yeah, everybody with mortgages, basically.
Well, yeah, there is that, and well, in that regard, I'm not talking my book because I've got a reasonably hefty one. So I'm from personal side, I'm not keen for rates to go up at all.
You're not. Yeah. No, look, thanks indeed for joining us, Mike. It's a pleasure to talk there about Deutsche Bank and the issues that not just affecting Deutsche Bank, but many banks, not just across Europe, but the global banking sector.